Ladies and gentlemen, welcome to the presentation of our PGE 2013 full year results. My name is Jakub Freilich. I am head of IR. I would like to warmly welcome our guests here at our premises, here in Warsaw, and those who joined us online. Good morning. Results presentation will be hosted by our management team, by Mr. Marek Woszczyk, company CEO and President of the Management Board, Ms. Magdalena Bartoś, CFO, and Mr. Grzegorz Krystek, Vice President of the Board for Operations and Trading. As usual, after the presentation, there will be opportunity to ask questions. Webcast viewers can do it via email. Now I will hand over to our speakers. Please, Mr. President, the floor is yours.
Thank you very much. Good morning, ladies and gentlemen, once again. So we have the pleasure to tell you a bit about our financial and operational results of the last year. So yesterday evening we have published our results for the fourth quarter of the passing year and the full year of results for the full year of 2013. We will discuss them in details with you today, and then of course answer questions as promised. First, I will give you a brief overview of the last fiscal year at PGE, presenting the highlights of our financial results, and then comment on the market environment that we had to live within. Then I will give you a quick update on the recent investment decisions in the company. Afterwards, as has been said, Mrs. Bartoś will get you through the more details of our operating and financial data. Then, following our presentation, we will be ready to answer all of your questions. Okay. The reports we have published show that last quarter of the last year and the full financial year confirm extraordinary strength of our company. Of course, we are happy to tell you that. And firstly, as of financial statements, EBITDA over 8 billion zlotys places PGE on the top of the Polish companies in terms of profitability. It is the highest number among Polish listed companies. Thank you. So this is the highest number among the Polish listed companies that have already reported their results for the last year. Secondly, EBITDA margin reached 27%, which not only stands out in Poland, but it is one of the highest number across the whole energy sector in Europe. Thirdly, PGE delivered a significant, and I've emphasized that, double-digit growth in net profit. The number is 14%, higher than a result of the previous year. And thirdly, given our financial strength, we decided to propose to General Meeting dividend payout at the top range of our dividend policy, namely 50% of our net consolidated profit will be offered as a dividend, which translates into a firm 1 zloty per and 10 groszy of dividend per share. In terms of the regulatory environment, I'd like to stress that these pretty results that we are happy to tell you about were achieved in a very very demanding environment, in my opinion. As a utility company, PGE operates in a world full of regulations. Some regulations have been well known, such as the climate policy regulations, for example, that started to have a more significant impact in 2013, since when Polish industry is subject to tougher rules. The industry is receiving less free carbon allowances. There are, however, more local regulatory uncertainties as well. We have an ongoing dispute on the future scheme of renewable laws And given inefficiencies of a current scheme, economics of co-combustion were affected, and more importantly, uncertain future postpones investments in this sector. The same kind of impact is visible in investment area in cogeneration. So moreover, due to lack of a support for cogeneration in last year, PGE ceased its operations at 2 gas-fired units. On the other hand, regulatory environment turns more favorable by introducing some elements of the capacity mechanisms. We already had a chance to describe that mechanism when we talked about our Opole second. And this type of a mechanism indeed improves economics of a conventional generation, including the assets of the PGE. As of our investments and contracts, last year there were several crucial developments in our investments portfolio. In particular, after introduction of the capacity mechanism, economics of Opole power plant has improved, which allowed us to start this project. So this is the project with a capex close to 12 billion of zlotys, is expected to be finalized by 2019. Secondly, after acquisition of over 130 megawatts of the wind farm capacity, together we, with our own development project, PGE had over 8% share of the market in terms of the installed wind capacity. So we are close to have installed capacity in the wind farms of 280 megawatts in total. Thirdly, the project of the building a gas-fired power plant, actually cogeneration unit at Gorzów has started. And what is important thing to know about this project, the economics are secured with the local supplies of relatively cheap gas. What is also worth mentioning, PGE secured hard coal supplies for the next 5 years, I mean the period from this year till 2018, successfully linking the prices of the coal to both electricity and commodity prices. What also needs to be noticed in order to complete the picture of our results, these are one of non-cash items. So last quarter of 2013, we decided to provide an extra provision for free carbon allowances we meant to be granted, and safeguarding this kind of a regulatory uncertainty had impact of close to 800 billion on our results. Secondly, weak market environment and the dropping electricity prices last year led to a thermal fleet review, and after running out a set of tests, we decided to do impairment of some cash-burning assets, reaching a total number of 350 million zlotys. In terms of our operational performance, so ladies and gentlemen, I think that our financial results, not only for the last year but for the previous years, may lead us to a conclusion that PGE remains a stable and reliable utility. However, the market environment is deteriorating for the conventional generation utilities. PGE managed to deliver stability in financial terms. It is rather uncommon among the other utilities across Europe. So PGE keeps improving its operational performance, which is well visible in achieved results over the last years. PGE is one of the few growing utilities in Europe with the recurrent high single-digit growth of EBITDA and low but double, I emphasize double-digit growth of net profit to equity. Last year's 10% of growth in EBITDA provides a very good starting point for the future growth. And what is important when we take into consideration that in coming years PGE will be carrying out a series of the growth investments. And in fact, that PGE is the only company that can afford growth capex, enjoying a relatively low, or young age of our assets. PGE has less pressure for replacing the capacity. And thus, given our financial strength, PGE is still capable of growth. 2013 net profit to equity grew by 14%, as I said, which drove earning per share to 2 zlotys and 20 groszy per share. So we hope that shareholders could feel satisfied with that numbers. So in brief, we confirm our position as a baseload producer and absolute cost leader in Poland. Our net generation remained stable despite we decommissioned some capacities, I mean Turów, which is to be replaced with the new investment. So we perform mostly due to a higher utilization of existing assets, thanks to the fewer repairs and modernizations than in previous years. Last year, we significantly increased our volumes sold to end users as well, taking advantage of the lowest costs in generation on the market. Ladies and gentlemen, after presenting results for the passing period, there is always a question what the future might look like for the company. We see, I believe we all see the improving situation in the economy, which is already driving demand for electricity up. We're happy with that. However, some totally opposite drivers were coming last year from, in particular, falling carbon allowances prices and from growing renewables generation. Especially growing renewables generation was shifting the demand to the left in the merit order, in fact, pushing conventional generation out of the market. So those opposite factors resulted in a decrease of electricity prices, and taking into consideration the forward nature of the electricity market, this negative effect will continue in this year and probably next year as well. So how does that impact PGE? Recovery in the economy looks firm and should continue, we believe, having impact on the electricity prices and consumption growth. Secondly, regulatory environment is becoming, in some aspects, more favorable to PGE, namely carbon allowances prices are driven up a bit. So is the electricity prices. So in such conditions, most efficient generators will benefit the most. And as I said, our fleet of assets is relatively the youngest one in Poland. Thirdly, conventional generation economics are less under the risk after implementation of elements of the capacity mechanism, I mean operational capacity reserves. It proves to perform according to the assumptions, resulting in a bit higher electricity prices that we benefit. So given the environment, PGE is very well positioned to take advantage on the improving situation, still keeping high margins to provide stable cash flow, we believe. And the last slide of my presentation refers to the important investments that we kicked off, or we plan to kick off. Of course, our flagship investment, you know about it, is of course Opole 2nd, hard coal project will increase existing capacity. by 2 units of 900 megawatts each. Notice to proceed was issued in January, at the end of the January, and since then contractual deadline started. Units are to be commissioned, the first block in July 2018 and the second in March 2018, respectively, of course, according to the stipulations of the contract. Besides the regulations I mentioned, economics of the project are facilitated also by a long-term contract for hard coal supply, which links fuel costs to commodities and decreasing risk for PGE. Other key projects besides Opole, so these are of course Gorzów CHP project. The project secured, as I said, with a cheap gas from the local source. The next is Turów, a very important project for replacing decommissioned capacities. We already decommissioned 3 units, each having a little bit more than 200 megawatts of a capacity. So the project will utilize a local source of the lignite, improving in a consequence the economics of the whole Turów complex. Tender is in progress, and we expect that the procedure to be finalized soon. I believe no later than in the second quarter of this year, maybe sooner. There's also a tender for cogeneration gas-fired units in Bydgoszcz and Pomorzany. So those tenders are in progress, as well as PGE is carrying out necessary upgrades and retrofits on an ongoing basis, but this is nothing unique, but rather routine job that we do. In terms of the distribution, of course, there are ongoing connections of the clients to our grid, as well as a set of modernizations of the distribution assets. We strive to report repeatedly the market about these facts. In terms of the renewables, after the recent launch of wind farm located close to a village, Resko, PGE has a portfolio of the project in renewables of approximately 200 megawatts that are to be commissioned over 2013 and 2015. In terms of the nuclear, recent approval of the Polish nuclear power program allows us to continue the preparatory works that have already been started due to the complex nature of this project, which is obvious. So thank you very much for listening to me, and now I will hand over to Mrs. Magda Bartoś, our CFO, who will get you through the details of our financial and operating results.
Thank you, Marek. Hello, everyone. Good morning. Following Marek's introduction, I will now would like to provide you with a comprehensive review of our financials. So firstly, we will go through the key numbers. Then I would like to walk you through our key value drivers of 2013. And lastly, we will take a look into our cash position and what we expect to happen in the coming year. What is our outlook for the future? PGE's performance in 2013 was strong. We underlined that, we are stressing that, and that also showed our superiority in the market. And that is also despite the challenging market conditions, and that is despite all the changes in the regulatory framework that Marek also described. Our FY13 EBITDA reached a record height of 8 billion. This is a 10% up versus prior year. But what is also important to us is that our Q4 operating profits grew both on reported and recurrent basis. Our underlying net income grew by strong double-digit, 14% up, with 4.1 billion of net profit, of net consolidated profit, that also allows us to share a large portion of that with our shareholders, providing the shareholders decision. Our operating cash flow grew to 7.9 billion. Those funds were utilized to finance our CapEx program and finance our dividends. But what is, I guess, important to underline as well is that we still remained prudent with our cash flow spending. Our capex is down by 10%, but as Marek just described, we are in the front gates, let's say, of a large capex program that we will be carrying out in the coming years. Our net financial position as such grew by 1/4. So we are a stable cash-rich company as of now, and we closed the year with 3 billion of net cash on our balance sheet. During the last year, we also confirmed our ratings and were granted with the Fitch investment rating in 2013, back in December, I guess. When it comes to our operations and generation assets, over the last year we have strived to manage those assets up to the maximum utilization levels. And as Marek said, over the last years in Turów we have decommissioned more than 600 megawatts of capacity. And with this, let's say, in the background, it is worth noting that our generation volumes remained flat in 2013. That means that we maximized assets available in Bełchatów and Turów to the highest levels. Our lignite assets are the most efficient assets in Poland, and that also was let's say, the underlying base for the excellent operational results in 2013. When it comes to our renewables generation, that amounted to 1.95 tera, with the key growth coming from wind farms and as a result of our recent acquisitions, with the biomass co-combustion going down due to deteriorated economics. Same reason was with CHP generation, with gas-fired CHP generation. Due to lack of support, we also decreased volumes of generation with this source. Now I would like to focus more on our key drivers, key factors that drove our earnings in 2013. We provided you with a chart that is hopefully an easy to follow map of the factors impacting our results. As we discussed earlier, 2013 was especially challenging when it comes to market environment and eroding prices. And that had a substantial negative effect on our earnings. We estimate the effect to be 1.5 billion. CO2 is also an increasing burden, another 500 million that is associated to this negative impact, especially, well, only in our conventional generation division. These two negatives were partially offset with lower costs of fuel and better retail margins. Please remember the retail margins are more and more under pressure, but in 2013 we managed to respond to those adverse market conditions with the two factors. We continuously focus on cost savings and efficiency measures. Initiatives delivered in 2013 totaled to close 500 million, with 80% of that coming from our conventional generation unit. And the upside coming from that is supposed to be a long-lasting effect on our financials. This is what we aim for. And the addition of our new wind capacity that we just described improved our earnings by 0.1 billion. But please remember, those were operational only partly during the year. 2014 will be the first year when our newly acquired assets will be operational for the full fiscal. In 2013, we continued a scrutinized review of our balance sheet base. That's what Marek also explained in the opening speech. We especially focus on the cash generation potential of those assets. And as such, we tested the assets and decided to impair those assets with the 0.3 billion. That is especially the thermal fleet, least efficient thermal fleet. We can call it a cash-burning thermal fleet. Pomorzany, Zgierz, and remaining a value of Dolna Odra. Impairment charges are, of course, necessitated with the market conditions, especially eroding electricity prices. that actually degraded the performance of those assets. Let's take a look into the financial results of our segments very briefly, because we just went through the key value drivers. But what I would like to stress is that we recorded half of our 2013 recurrent earnings in our conventional generation business. This is the largest part of our business, with another significant portion of earnings, approximately 1/3 of our earnings, coming from a stable regulated business and distribution. Both in Q4 and FY13, our generation business suffered from the market adverse conditions, as we spoke, mainly prices of electricity and CO2 increasing burden. Distribution has strengthened their position. RAB is being finally fully remunerated, and this is what we expect to also improve on earnings in 2014. And distribution is truly a stable, low double-digit growing business, potentially high single-digit growing business. Retail and wholesale businesses, as you see it here, shall be read together, as the impacts of our internal transfer prices are visible. But when read together, it is also worth noting 2013 was especially successful for our trading business and retail business as well. As Marek mentioned in the beginning, we managed to significantly broaden our consumer base, and that also impacts growth of earnings and profits in these businesses. Our group investments and acquisitions in 2013 reached 5.5 billion. Of these capital outlays, approximately 50% were recorded, were focused on conventional generation. A pretty straightforward reasoning. This is the largest EBITDA contribution of the group. But in 2013, we mostly focus on modernizations in the conventional generation to keep our assets at the highest quality. Alongside the necessary maintenance investments in the conventional generation, we also focused on expanding our business, and that is mostly in renewables and distribution grids. More than half of the distribution investment is directed into development, into expansions. We added 2,500 kilometers of lines in our distribution business and a number of stations. 1/4 of the total investments of the group is focused on renewables and expanding our business with the capacity of wind farms. As we spoke, acquisition of Dongen and Iberdrola assets. Based on our 2013 results, we proposed then a dividend to our general annual shareholders meeting of 1.1 Polish zloty per share. This corresponds to a payout ratio of 50% of our net consolidated profits. This is within our dividend policy targets, of course. We would like and we maintain our commitment our commitment to shareholders that we will be a stable dividend return provider. Our balance sheet is strong. We are ahead of a large investment program, but still there is plenty of room to maintain our dividend policy and keep our promises to shareholders. Our balance sheet has been very strong in the last years. We kept our cash position for the majority of time, and we prudently distributed those cash flows into basically two areas. One was the capital outlays, the other one was dividend. For the coming years, though, we expect the intense CapEx program to provide some more optimal structure of balance sheet with external financing coming into our balance sheet. And as said in our previous presentations, we would like to keep the maximum level of our net debt to EBITDA at 2.5. And now I will turn to our assessment or to our outlook for the business of in 2014. We still believe, or we see, that business climate will be challenging. As said, The electricity prices drop has a delayed impact on earnings of utilities, and same as with PGE. So we expect our conventional generation plus wholesales and retail businesses to suffer from that drop of 2013, even though we believe those will turn around and start a moderate growth coming forward. Difficult regulatory environment will also add a burden to conventional generation business in terms of CO2 emissions. We expect that to be an increasing part of our cost base. Our retail business is also expected to suffer or to bear additional burden costs related to cogeneration support and the necessity to redeem certificates of origin related to that. Our distribution business will remain a stable source of cash flows. We expect that fully remuneration of RAB to benefit. We expect to benefit from full remuneration of RAB in the coming years and provide for moderate growth, little or stable businesses. Even though the business environment will remain tough, we are confident that in the coming years we will generate enough funds to provide for the large capex and investment program. And we expect that relative to 2013, our capex will be higher. We will focus our efforts on highly efficient conventional generation projects, but this is not without the reason. We want to allow us to bring our production capacities into a completely new level. We want to lay down a good foundation for future growth and a good foundation for future earnings. And with that, I would like, on my behalf and Marek's, thank you for listening, hand over to Kuba for the Q&A session.
Thank you very much. And now we have the opportunity for our guests here in Warsaw to ask questions first. My offer, if you wouldn't mind asking 2 questions at a time, to be easier to follow and easier for the speakers to answer them directly. Thank you.
Hello, Paweł Puchalski, Dom Maklerski bez UBK. If we might refer to slide 14, where you are guiding for 2014, question on wholesale and retail. You say lower, and my question would be, are we talking about coming back to 2012 figures, or maybe the 4th quarter of retail is a good proxy for the entire 2014, which would be a very negative sign? I just want to know the guidance. Is it just down or halving?
We will not provide you with the specific figures, of course, but as said and as seen, and we show that, the wholesale prices will be lower, and we know the extent of that effect. We read wholesale and retail together. What comes to retail is then the downgrade pressure on margins with the competition and additional commitment or additional obligation to redeem the certificates of origins. All of that together guides us to a conclusion that earnings of our wholesales and retail business will be lower. We will not inform about the exact figures, but we expect that to be visible.
I think this is a consequence of what I said, forward nature of the electricity market. So what we are producing and selling this year, basically making our result this year, was already sold last year. So you know the prices that the electricity was sold for this year. So we will not hide that this year is to be as comfortable for the generation segment as it was the last year. This is just our warning and alert, and we let's say communicate it with you.
ING. Maybe if you don't want to speak so detailedly about these segments, maybe you could comment on 2014 Bloomberg EBITDA, which shows 6.7 billion. And I was just wondering if you feel comfortable with this number, or do you think you could exceed the market's expectations? Thank you.
Excuse me, Milana, which EBITDA we are talking about? If you could, Bloomberg expected.
From PGE.
Probably. We can, ladies and gentlemen, we can only guide you through the key important value drivers. We will not be reporting our commitment to the market, but I guess we provide you with a very detailed guidelines for some modeling, and we expect the EBITDA of the total business to be under pressure. We know conventional generation and wholesale business, retail business, will be suffering from some adverse external factors. We know that we will do our utmost efforts to cover for that with efficiencies measures, and we expanded our business with renewables, but that does not add as much as we potentially may have at stake with conventional business. Distribution will remain flat or moderately going up, as we know RAB will be revaluated. All of that should drive to a very, very specific measure when put into numbers.
Piotr Dzięciołowski from Citibank. Going to your numbers, I find them extremely misleading, because there's a number of elements. You know, your power price dropped by 10%, CO2 costs go up, and yet company shows a double-digit growth against all of the other companies. So, referring last year, you reported 1.8 billion zloty. Now there were two elements which really improved it to 2.2 billion. One of it was accounting change, which has never been explained. Can you please explain it? What happened, and do you have other measures by which you can move OPEX to CAPEX? I think it's extremely positive for shareholders because it increases the dividend payout, but then maybe let's move more of the OPEX to CAPEX. And second, on this subject, can you explain the other adjustment line, which suddenly mysteriously jumped by 300 million zloty? What is behind the number? So that would be my first question. And sticking to a new policy of two questions, I wanted to ask you about your coal contract, because I find it also quite amazing in the current market environment to lock in yourself into 5-year contract when everybody wants to be open, and then lock in your margin when you tell us the power prices should go up and expand clean dark spreads. By referencing coal to power, you actually eliminate the most important value driver of this company, power prices going up.
So let me start with accounting policy change. I don't know which mic is better, which one I should do. Let's try with this one. So, commenting on the change of the accounting policy that has been explained in details in the financial statements. So please refer to that description. I will give you some guidance now, but the description in financial statements is detailed enough to follow what has happened. What we decided is in 2013 is to capitalize on some of the previously recognized costs, previously recognized within the reporting period, related to extraction of lignite. So when you extract lignite, there are certain costs you need to bear in order to get access to the layers of lignite, and those were immediately expensed in the past. Right now, we expensed it partially, and we capitalize partially to simply fulfill the matching concept. So we, as with depreciation, we increase on the value of our assets and then expense proportionally I do not know any other measures of such. Otherwise, I would be reporting that with the 2013 numbers. So I can, I guess, comfortably say that as of now, I haven't identified any of such measures. Neither has KPMG that audited our financial results. When it comes to the value drivers and the other factors of 300 million, as I understand, what we are talking about is here we've got a couple of impacts. The key important one is certificates with retail, certificates of origins. A couple of changes in provisions that are purely operational, business-related, not of such a significant, important value as recultivation provision or other, let's say, more of the one-off items that are reported in the below line. Piotr, go ahead.
But do you put it in the recurring numbers for some reason? Why? If it's a one-offs, why didn't you eliminate them? Because actually they are responsible for, you tell us, oh, we increased the net profit to 4.1 billion, out of which 300 is really one-off elements in other division. I mean, then, that's why I'm asking, what's the number going to look like next year?
I'm not talking about the numbers that we associate or we kind of treat as one-offs, because those are presented between the recurrent and reported lines, and the number is 166. Here I'm talking about business as usual, different factors that are impacting our numbers, that is with the certificates of origins being a large part of it, and a different portion or a full list of other minor, smaller elements, more business as usual, not one-off items.
Is this recurring element or not? Because I still don't get it.
If we reported it with the recurrent line, we may expect some of the similar effects.
So next year you will have in other elements 200 million or so. Is this correct understanding?
I cannot confirm on that, but this is a recurrent item.
Regarding our coal contract, we tend to build our competitive advantage on highly effective generation units. Thus, we want to secure our margins long term. That's why coal contract has to be profitable for both sides to be secured in long term. That's why we relate prices of coal in this contract to prices of electricity. And of course, when those prices go down, our price for coal will be lower, but also when they go up, prices of coal that the mining company gets will get higher, but we want to secure our margins. That's most important for us. We strongly believe that more effective generation units will give us the edge over our competitors on this market.
The contract itself does not exclude the possibility to be renegotiated. It's not the type of a contract that's been done once forever.
Leszek Iwaszko, Societe Generale. Two quick questions. If you could give an outlook for LTC compensation revenues in 2014. And the second question, price of coal per gigajoule. In 2014, how much you expect it to be down versus 2013? So LTC compensation and coal, cost of coal.
Could you rephrase because I didn't follow? You mean compensation payment? You mean
With the LTCs, this is the question.
from long-term contract?
So long-term contracts, LTC's revenues within the revenue line and within the other operating result line? This is the question. With the revenue line, we are talking about 300 million. All of those details you've got presented in the appendix, slide number 19. Outlook for 2014. Outlook for 2014 is not as straightforward as we expected that to be, because there were some adjustments in 2013 as well, and as you know, the methodology follows the efficiency of the business. So I would expect it to be at the average level of last year's, but it's difficult to, let's say, straightforward. It's not a straightforward calculation.
And now maybe we turn to our interviewers. There was a... Oh, yeah, sorry.
About the coal prices, we were pretty extensive with information when communicating the Opole project. And in that presentations, we communicated that we expect in the short and mid-term the prices to remain stable.
So 2014 price per gigajoule versus 2013, we should understand the price per gigajoule in 2014 to be stable versus 2013?
That's exactly what I said.
Okay, thank you.
Thank you.
We mean, of course, hard coal. Hard coal.
So one more question. I wanted to ask about the efficiency improvement program. You stated in your presentation that there was 494 million positive impact in 2014. Is it the maximum that you have achieved, and or maybe there are some more possibilities? And what number of these efficiencies would you expect for 2014 and 2015? Thank you.
Excuse me, could you repeat the question? I didn't get the beginning.
I wanted to ask about the efficiency improvement program. You state that there were 494 million cost reductions in 2013. And how much of that, is it all you can do? And how much of that we could see in 2014 and 15?
On this program, we just started recalculating effects for 2014 and 15, and we don't have exact numbers right now.
To comment on the first part of your question, Milena, close to 500 million of savings in 2013, and we will focus to keep this a long-lasting effect. So it's a recurrent effect. It's not a one-off related to a specific transaction. Is it all we can do? Definitely not. There are efficiency measures that we are, as Grzegorz said, continuously reviewing and implementing. About the exact numbers, we are not capable of informing you right now, but the number of 2013, we will strive to keep it a long-lasting effect.
And now we turn to our interviewers. We have a few questions from Fred Barazzi from Goldman Sachs. First refers to the distribution line. What is the difference between reported and recurring EBITDA in distribution? And the second one, when do you expect to provide an updated strategy plan?
About reported recurrent distribution, and then I will hand over to Marek about the strategy. Our distribution business is more a business as usual with less significant one-offs. We had in 2013 some provision updates related to use of land. But apart from that, there are no significant one-offs in distribution.
I guess the second question referred to the strategy of financing. What do we expect? Yeah, as I said, okay, I misled that question. As I said many times, so we expect to deliver the actualized strategy, let's call it a new strategy, by the second quarter of this year. Of course, we strive to deliver it as soon as possible, but we believe that April, May, this should be the time when we will communicate the actualized strategy of the company.
We have a question from Tomasz Stępień from Argus. In 2014, there was introduced operating reserve scheme. What would be impact on generation volume and financials of PGE in coming years?
Operational reserve impact on financials.
Yeah, pretty. So,
Operating reserve margin, what would be the impact on our operationals?
Answering this question, I might tell in this form that the impact of functioning operational reserves with this year budget, which is around 400 million zloty, is that the prices of the peak contracts on the spot market grew at from 4 to 7 zloty per each megawatt hour. So this is the positive impact that we are receivers of, the positive impact, because our margin grows basically, and it proves to perform according to its assumptions. I mean that kind of the ancillary service, which is the operational capacity reserve. Less important from the PGE point of view is the total budget. I mean, we of course, we are beneficiary side of the budget of the operational capacity reserve mechanism, but the most important factor, most important effect of that type of the service offered by the TSO is the impact on the prices on the wholesale level that increases our margin that we profit on.
We have also one follow-up. Could you comment and give an update on what, if any, generation capacity retirements are expected in coming years at PGE?
Yes, we expect to retire some capacity based on hard coal in coming years. Other capacities, especially in CHPs, they depend strongly on the support mechanisms that will be proposed by our government. In this respect, we prepare strategies for both strong mechanism for supporting cogeneration and lack of this support.
I may add something to it, because we secured our part of our hard coal fleet, I mean Dolna Odra, under the coal capacity reserve that should start beginning from 2016 and may last till 2018. This is as of now, and of course our strategy will give more detailed answer on the issue when we will be decommissioning our assets. Yeah, that's what I may say today on that issue.
Now we can go back to our room. Guests, please.
So maybe one more question regarding the CO2 provision. If you could tell us how you're gonna approach this provision in 2014. Should we expect another large provision in the fourth quarter of 2014, or maybe another approach? Thank you.
Our Our accounting policy states that the company, the group, provides for the CO2 allowances that were not granted within the reporting period. That is why for 2013 we provided for the CO2 allowances that are supposed to be granted to the group for the 2013 emissions. Once we receive those, we will recover the provision. What happens until the end of the year is again will be a stable follow-up of the accounting practice. So if we receive allowances for 2014 in 2014, we will account for that. If not, we will also reflect it in our financials.
Okay, and just one more thing, but are you thinking about maybe splitting the provision like quarter by quarter, or is it going to be a bulk one?
That is also an accounting policy that is described in our financial statements, so please refer to that one, but our treatment is not FIFO, so we will be then managing the allowances with the average cost method.
Thank you for follow-up questions. I wanted to ask you about the capacity market discussion. You know, you present very good results. You're a very rich company. You pay very high dividends. You say that Opole makes business case. How strong you feel about your cards before the discussion requiring more money to be paid to the baseload generators? So that would be my first question. And on second, if you look on your distribution, after the reform, you're now going to make, if your numbers don't go down this year, you actually will outperform the regulation by 1.5 percentage points because your RAP stays the same, return goes down, and your results, as you say, go up. How strong you feel about making an excess return on the business, which is regulated, and not passing through the efficiencies to the customer's bills?
Can you please repeat the first question or the meaning of the first question?
I mean, you're a rich company and capacity market is to provide you more money. So you go to the government, to the regulator and tell them, we want to make more money. And when I look at your balance sheet, your cash flow, and your official guidance is that you make return. So I question as an analyst, but also as a customer, you know, how strongly you feel that you can get more revenue from capacity market? And will the government actually say, yes, you're rational, let's increase the bills to the society, to voters, because PGE wants to make more money to pay more dividends? So I just want to understand at the beginning of the discussion where we are. I mean, because I think, you know, I understand the Tauron case, where the generation is really struggling, but I don't understand your case. Because you can be, as you said, you are the biggest beneficiary of the operating reserve, which is exactly a wrong mechanism to introduce.
I think that I already said it many times that the operational capacity reserve is not an ultimate story. This is not an ultimate solution. This is only a temporary solution, and this tool addresses the problems that existing assets may have. Not ours. Our competitors had bigger problems that we have, but of course, because we are messing a little bit to issues. One issue is about how PGE is in terms of its financials. The second, how the whole market works, performs, which is systemic solution. So capacity market, this is, let's say, systemic discussion, systemic or dialogue with the public institutions on how the market model should look like. how to better balance, let's say, the interest of the market players. Of course, we as a PGE, as a leader of the market, and I believe as a leader of the minds on that market, this is at least my personal ambition to be like, let's say, to be such a leader. We are strongly involved in that discussion. So our position is quite clear. We should have because we don't run a business that, should last only a decade. We are running a business that should be calculated in terms of the couple of the decades, for example, okay? So yes, we need a systemic final solution, which is a, let's say, capacity market. And our position is quite clear. We should have a discussion and we should deliver the solution on how so-called capacity market should look like in Poland. Of course, our intention is not to bring about the higher prices for the customers, because these are our customers we live on. But our intention is to, let's say, to make the profile of the risk better for us. And this is a consensus between us, among the other players of the market, between us and our competitors. Of course, there are some particularities that we, at this stage of our internal discussion, differ a little bit. We are different in terms of our positions, but we believe that we will reach the consensus. There is no doubt, this is PGE perspective, that we should together, I mean, we and our competitors together commit to the final solution that will be both satisfactory for us as a sector and for our customers and for the whole economy. Meanwhile, we should not resign from thinking on how the operational capacity reserve should perform, should look like. Because it was introduced quite rapidly, quite soon, because this was a, let's say, a demand of time. But it does not mean that it cannot be adjusted, improved. And we also, we, PGE, and our partners on the market, the other stakeholders, we also think on how to maybe adjust that operational capacity reserve in order to perform better in terms of not only, let's say, minimizing the risk of fixed cost to be uncovered today, but also maybe to generate some signals for investment in the future, which was not the original assumption when we thought about the operational capacity reserve. Let's say it rather belongs to the whole mechanism of capacity markets that we think about. So basically, and let's say, summing up what I wanted to say, operational capacity reserve is about minimizing the risk of fixed costs to be uncovered. The effect is higher prices in terms of the peak contracts. Capacity mechanism, capacity market model is about, let's say, sending the signals to the investors whether to invest or not, depending on the demand supply situation in the future, which operational capacity reserve as it is now in Poland cannot deliver. So there is no fight within the sector. There are no two different, let's say, positions. We don't have two different positions. Of course, we're talking about some details, but for example, should it be a centralized or decentralized model of a capacity mechanism functioning? We are quite advanced in terms of that discussion, but we all believe that we will reach soon a consensus, and then we will say, communicate to the market. I mean, we as a sector, as a set of sector or branch stakeholders, industries, basically. Right?
Second question was about distribution.
Maybe adding a little bit to what Marek just has said, we plan on investing 40 billion zlotys over the next 5 years. So those extraordinary results, we reinvest in our capacities. Apart from 2 units in Opole, which will be most modern hard coal-fired units in Poland, giving us better efficiency. We construct gas-fired unit in Gorzów. We also think about, we also run other investments in generation. State is responsible for energy security of the supply in Poland. And legislation, as Marek just mentioned, doesn't give us strong impulses for new capacities in the market. But using the mechanisms that are present, we also have advantage of, we take this opportunity to invest in new units because of rising prices out of these mechanisms. Regarding distribution, we plan to spend 1.5 billion zlotys every year. So this is also where those earnings that we have go.
And one more was the rationale behind the distribution outlook. So what we are saying is that distribution has reached its full remuneration of RAB, but we are not saying RAB will remain stable. We continuously invest in our distribution business. This is a solid cash flow generator, and more than 1 billion is invested each year in distribution, and distribution segment also agreed with the regulator the development plan for the coming years that provides for large investment capex programs. So remuneration is higher not only because we are fully remunerated for RAB, but also because RAB and the value of our assets is increasing.
Okay, it seems that there are no more questions. Okay, there's one follow-up.
Hi, Wojciech Niesta, Nordea Pension Fund. Do you expect the positive effect of fewer maintenance repairs in your most efficient part of the fleet to reverse in 2014? So will there be more maintenance repairs of your best generating blocks next year?
In upcoming year, yes, but we invest that, we will use that in future to improve our efficiency, and then the costs will go down.
Okay, Paweł.
Again, the same question. Can you monetize those improved efficiency of your lignite fleet in 2013? We can talk freely about 2013, can't we?
Monetize the effects of 2013?
Of very good efficiency of your lignite fleet, because you said quarter
Utilization of assets, this is what you're asking.
Yes.
It's a high single-digit increase in utilization of our Bełchatów fleet.
We don't have 2014.
I guess Grzegorz gave an answer to this question, that we will be investing in maintenance, modernization, TO, and wear of our assets.
No, the question is, did you neglect repairs on your best blocks last year? Thus, you will have to have more repairs in 2014.
That is a very straightforward question. I cannot comment on any neglection, but maybe Grzegorz will give you some details.
We didn't neglect repairs. We have a program of preparing our units in Bełchatów to higher emission standards, and this program will monetize in upcoming years. The next year we will be more advanced in this program, and thus we will not only meet stronger emission standards,
but also we will improve our, we will prolong our periods between major overhauls.
If I might, final comment. If you are saying we expect high capex, that implies modernization, renovation. Modernization, renovation keeps some units not working for months, weeks. So if you are telling us in 2014 we want to invest, you are telling us in 2014 efficiency will be lower than fourth quarter.
Now, I feel a little bit guilty, and maybe I misinformed you at one of my slides, because I used the phrase or word fewer repairs. Fewer repairs. I didn't mean that we resigned from the necessary repairs and necessary modernizations, but we optimized our timeline on how we do this. That's the only, let's say, information I wanted to transfer to you. So if I, let's say, mislead you, so sorry for that.
I just wanted to clarify on the distribution side, because my question was, your RAB actually grows very little because you are just break even. Now, what happened was that the return on RAB moved down from 8.9 to 7.3, which is, in your case, roughly 200 million lower EBITDA. If you actually make EBITDA flat, my calculation indicates that you will achieve above 7.3% return on RAB. And the question is, you are 1 year ahead of the review, achieving excess of the return, because the deal with the regulator is you make 7.3% because that's the cost of capital and so on. You will be making an excess return on RAB going 1 year into regulatory review. What's the risk you will be reduced? How do you assess regulatory risk in light of artificial, super high returns, excess returns in the distribution?
Do you think that the regulator is willing to change the regulatory model? I don't think.
I met Mr. Bando yesterday, and he told me he's considering, well, we'll see who the new regulator is, but he said we will combine TOTEX and CAPEX, but you don't see the risk that you will be making an excess return versus allowed return, and nobody will pass through this super returns to customers?
No, don't see that this is a, let's say, reasonable risk or serious one.
And one thing that is worth adding, EBITDA is not only remuneration on RAB, and distribution tariff is not only remuneration on RAB. So there are a couple of more measures that you need to take into account. Yeah, with this I can close, I guess.
Just following up, something that we're a bit missing. RAB was not fully remunerated in 13. It will be fully remunerated only in 14. So the decrease in RAB, decrease in WACC actually will be offset by the full remuneration received in 14.
That's the other side of another aspect of the issue.
Okay, if there's no other questions, I would like to thank you very much. Thank you to our speakers, thank you to our guests, and see you in May on Q1 results. Thank you.